Hi, this is Mark Hoy. I'm a national mortgage lender and I'm going to talk to you about DSCR loans. So most people think getting a mortgage means handing over your entire life story, pay stubs, W-2s, tax returns, your firstborn child. But what if I told you there's a loan where the lender doesn't care about your job or your income? The only thing that they care about is one thing. Does the property pay for itself? That's a DSCR loan, and today I'm breaking it down so simply that your grandma could explain it at a bingo night. So what is a DSCR loan? DSCR stands for Debt Service Coverage Ratio. It's a fancy phrase, but it's a simple idea. It answers one question: does the rent cover the mortgage? And that's it. It's not your salary, it's not your tax returns, it's not your side hustle selling candles on Etsy, just rent in versus mortgage out. If the rent covers the payment, you're in the DSCR game. So I'm going to break it down even more simply for you and show you the formula. Here's the simple math. DSCR equals rent divided by mortgage payment. If the rent is $2,000 a month, and the mortgage payment is $1,800 a month, you get 1.1. That means the property pays for itself and then some. Most lenders want 1.0. Some want 1. Some will even go below 1.0 if everything else looks good. But the big idea is this: the property qualifies, not you, the buyer. So who DSCR loans are for? These loans are built for real estate investors. Not your first-time home buyer, not primary residences, not your cousin trying to buy a house with no job. DSCR loans are for people buying rental homes, for Airbnbs. They are purchasing multifamily properties, portfolios, cash flowing assets. If you're trying to build wealth through real estate, DSCR loans are like cheap. Investors love them. Well, several reasons. So reason one, no income documents. They don't have to provide W-2s and their pay stubs and tax returns. Your job could be an astronaut, you could be an Uber driver, it doesn't matter. Reason two, they close fast because you're not providing all of that paperwork to the lender and we're just underwriting the property. They have a quicker turnaround time. Reason three, flexible credit requirements. Check with different lenders. Different lenders have different credit scores. And reason four, you are only reason five, you can scale. Traditional loans help you or cap you at 10 financed properties, where DSCR loans don't care if you have one property or two or 200. So there is a catch to DSCR loans. Every loan has trade-offs. DSCR loans have higher down payments, usually 20 to 25. They also have higher interest rates. So you're paying for flexibility. It's like buying TSA pre-check for your mortgage. They also will require bigger reserves, which just means extra money in the bank. Lenders want to know you can handle a rainy day. And this isn't like $1,000 in the bank. We're talking several thousand. If you can't live in the property, this is what that. So let's do a real life example. Let's walk through a real scenario. So you find a rental property in Detroit for $200,000. It rents for $1,900 a month. Your mortgage payment comes out to $1,600. 1,900 divided by 1,600 equals 1.18. That's a solid DSCR ratio. You put 20 to 25% down and you close. The rent covers the mortgage, you pocket the difference, and you start building equity. That's how investors scale through the DSCR program. So we talked a lot about who the DSCR program is for. Let's talk about who it's not for. So DSCR loans, they are amazing, but not for everyone. You probably shouldn't use a DSCR. Well, you can't use a DSCR if you're buying your first home to live in, if you're focusing on primary residences, if you don't have enough money saved for reserves, if you want lowest possible rate, or if you're just not ready or responsible yet to be a landlord. This is an investor tool, it's not a shortcut. Some things that you can do to prep to become a good candidate for a DSCR loan is down payment. So again, 20 to 25% saved for the purchase price of your home. You can't go through your lender to get that. Reserves, plan on having a few months of expenses saved up in savings, untouched and seasoned, and a property that cash flows. So look at rent estimates, market rent, Airbnb projections, And lastly, a lender who actually understands DSCR. That is actually more important than you think. So DSCR loans are one of the simplest ways to start building a real estate portfolio without jumping through the unusual mortgage hoops, or usual mortgage hoops, I should say. If the property pays for itself, you're in business. And if you want help running numbers, comparing DSCR lenders, or figuring out if a property qualifies, reach out. I do this every day, and I'd love to help you build your next move. So like, subscribe, and drop a comment with the next mortgage topic you want me to break down.